1 ounce of gold. Just 31 grams. It fits in the palm of your hand. It produces no yield, pays no dividend, does nothing except exist. And yet that silent piece of metal holds a secret powerful enough to destroy almost everything you have been taught about wages, work, and money. 2,000 years ago, a Roman centurion, a man commanding around 80 soldiers on the frontier of an empire, earned about 38 ounces of gold a year. Today, a United States Army captain, roughly comparable in rank, pressure, and responsibility, earns about 36 ounces of gold a year. Let that sink in. 2,000 years, 2 empires, 2 continents, hundreds of paper currencies created, inflated, and destroyed. And yet the real wage for the same level of blood, stress, and responsibility barely moved. That is the trick. The crowd thinks wages are rising every year. In reality, most people are just running on a treadmill programmed by the system. This video is not telling history for entertainment. It is using 1 ounce of gold as a measuring stick across 2,000 years to show you something much colder. Gold did not change. The measuring stick used to pay you did. Here is how we expose it. Not with dollars, not with euros, not with official inflation numbers. Just one simple metric. The number of working days required to buy 1 ounce of gold. If that sounds strange, keep watching. Because in a few minutes, you will see why a Roman soldier, a Victorian factory worker, and a modern worker are all linked by the same rule. Not the rule of the stock market, the rule of real purchasing power. Here is the twist. An ounce of gold is not just metal. It is compressed time. It is labor, youth, sweat, and human risk condensed into a measuring stick that does not know how to lie. Under the Roman Empire, the monetary system was built like a pyramid. At the top sat the gold aureus. Below it, the silver denarius. And below that, copper coins for daily transactions. A Roman foot soldier earned about 2 ounces of gold a year. That means 1 ounce of gold cost him half a year of his life. Half a year marching. Half a year sleeping in mud. Half a year standing guard in the cold, waiting for arrows to fly. But for a Roman centurion, 1 ounce of gold cost only about 10 days of service. And what could that 1 ounce buy? Roughly 350 loaves of bread, a quality toga, or about 1 month of rent in Rome. Remember that number, 350 loaves of bread. Because over the next 2,000 years, empires will change names. Maps will change color. Money will change form. But that ratio will refuse to die. Then Rome began to die, not because of one single battle, not because barbarians suddenly stormed the gates, but in the way empires usually die, their money is corrupted from within. Over generations, Roman emperors kept debasing the denarius. The silver content was cut again and again, from nearly pure metal into a distorted shadow of what it once was. That was how they printed money before printing presses existed. They created no new wealth. They just stretched the measuring stick. Prices exploded. Trust collapsed. Trade fractured. And when Rome fell apart, Europe contracted with it. Cities thinned out. Commerce weakened. Productivity collapsed. By the 13th century, in England, a skilled stonemason had to work more than 200 days, almost an entire year, just to buy 1 ounce of gold. That is the key turn. Gold did not become expensive. Human labor became cheap when the civilization behind it was no longer strong enough to protect productivity. But then the wheel of history turned again. During the Age of Exploration, the Spanish stormed into the Americas, plundered the Aztec and Inca empires, and shipped gold and silver back to Europe in entire fleets. The supply of precious metals surged, and in that rare period, gold actually did lose some purchasing power. Notice what that means. Across 2,000 years of history, gold only truly weakened when its physical supply was massively increased through violence, conquest, and blood. On a continental scale, it took centuries to do that. Compare that to modern paper money. The supply of dollars can multiply in a very short period of time. No war fleets, no colonies, no need to seize treasure from another continent. just a few clicks. And then, in 1717, Isaac Newton, yes, that Isaac Newton, serving as master of the Royal Mint, fixed the price of gold at a set level. An anchor had been dropped, and the world was about to enter a period of monetary discipline that modern people can barely imagine. That anchor held for a very long time, a very long time. In 1717, Isaac Newton, yes, that Isaac Newton, serving as master of the Royal Mint, fixed the value of gold at a set level. An anchor had been dropped, and for nearly 2 centuries after that, prices stayed stable in a way modern people can barely imagine. Not because human beings were more moral, not because those in power suddenly became virtuous, but because they were restrained. Governments could not spend what they could not back with physical gold. They could not create more labor time with a signature. They could not quietly cut society's wages by stretching the measuring stick. Under the logic of the gold standard, 1 ounce of gold cost a factory worker about 1 month of labor, and it still bought almost exactly what it had bought in Rome, roughly 350 loaves of bread, a decent set of clothes, 1 month of rent. That was what money looked like when it was forced to stay honest. But the 20th century shattered those handcuffs. World War I was too expensive to finance, with money tied to gold. Governments suspended the gold standard and began printing paper. After the war, they tried to return to the old system. But the world had already changed for good. Once power has tasted the freedom to spend without physical discipline, it almost never wants to go back. And then came the largest legal theft of the century. In 1934, Franklin Delano Roosevelt did something that, if it happened today, people would call by its real name: asset confiscation. The U.S. government turned private gold ownership into a federal crime. Citizens were forced to sell their gold back to the state at $20.67 per ounce, not because the market chose that price, because power chose it. And the game did not stop there. Right after most of the gold had been collected, the government raised the official gold price to $35 an ounce overnight. Every dollar people had been paid lost roughly 40% of its value against gold. No new factories had been built. No harvest had suddenly improved. No productivity miracle had taken place. The measuring stick had simply been stretched, and the gap had been transferred from the public to the state. An average American worker at the time earned around $1,500 a year. With gold at $35, he had to work roughly 8 to 9 days to buy 1 ounce of gold, more than a full week of labor for the same ounce. Then came Bretton Woods. The world rebuilt the monetary order around the U.S. dollar. Major currencies were pegged to the dollar, and the dollar was pegged to gold at $35 an ounce. It sounded stable, and yes, it was more stable than the world we live in now. But pay attention to the fatal difference. Gold was still at the center of the system. Ordinary people were simply no longer allowed to touch it. That arrangement lasted 27 years, until one president decided that mathematics no longer applied to America. Remember this number, 1971. On August 15th of that year, Richard Nixon went on television and cut the final link between the dollar and gold. From that moment on, money was no longer forced to stay honest. No physical limit, no metallic anchor, no handcuffs restraining the ambitions of power, only a promise. And that promise could now be expanded without limit. What followed was one of the most violent repricings of assets in modern history. Gold exploded from $35 to $850 by 1980. Then it fell. Then it crawled back. Then it broke above $2,000 during the pandemic. And now it hovers in the range of several $1,000s an ounce. But the price chart was never the most disturbing part. The most disturbing part is this. In 1971, an average American worker earned around $7,500 a year. With gold at $35, it took less than 2 working days to buy 1 ounce of gold. Less than 2 days. Now look at today. The average American may earn somewhere around $60,000 to $70,000 a year. On paper, that sounds like a richer world. But gold now trades in the thousands. And to buy that same 1 ounce of gold, the modern worker has to give up 2 to 3 weeks of labor. 2 to 3 weeks, not 2 days. That is nearly a tenfold increase in effort for the same piece of metal. A piece of metal whose chemical structure has not changed at all. Gold did not change. The dollar was diluted. Since the Federal Reserve was created in 1913, the dollar has lost more than 96% of its purchasing power. And here is the ultimate test, the bread test. 1 ounce of gold today still buys roughly the same basic survival basket it bought in Rome and under the gold standard. About 350 loaves of bread. The measuring stick did not move. Everything else was distorted. So what is 1 ounce of gold really telling you? It is not telling you whether you are rich or poor in the way social media likes to measure wealth. It does not care about your car, your portfolio, or the house you post online. 1 ounce of gold measures something far colder. It measures the real value of human labor. When 1 ounce of gold starts costing you more working days, that is a red warning light. Not because gold suddenly became greedy, not because this metal woke up one day and decided to turn against humanity, but because the currency paying your wages is weakening. This is where most people get deceived. They look at nominal wages. They see the number go up. They see a few percentage points of raise every year. They see a bigger bank balance, and they think they are moving forward. But if the measuring stick is being stretched faster than your wages are rising, you are not moving forward. You are just running faster to stay in the same place. That is why gold is not the real subject of this video. Your time is. Now look at the whole story again. Rome, 1 ounce of gold bought roughly 350 loaves of bread. The Middle Ages. Productivity collapsed, and the number of labor days needed to buy 1 ounce of gold surged. The gold standard. An anchor was dropped, and prices stayed nearly flat for generations. 1934. The state confiscated gold and devalued the currency overnight. 1971. The final anchor was cut, and ever since then, the number of working days needed to buy that same ounce of gold has expanded in a way the modern worker barely notices. These are not disconnected chapters of history. This is the same pattern repeating. When money is tied to something that cannot be created at will, human labor is better protected. When money becomes an unlimited promise, that promise is always stretched, and the thing stretched with it is the worker's life. The days you have to work, the hours you have to wake up for, the years you have to trade away just to maintain the same standard of living your parents could buy with less effort. Paper changed form. Human behavior didn't. From here, there are 3 rules you need to remember. Rule number 1, never measure your wages only in paper money. Not in dollars, not in euros, not in any national currency. Always convert them into something harder to dilute. Gold, silver, land, energy, anything standing closer to real value than the promise of a central bank. Rule number 2, never let nominal gains seduce you. A higher salary does not necessarily mean you are richer. A larger portfolio does not necessarily mean you are preserving more wealth. If 1 ounce of gold, 1 house, or 1 basket of essentials keeps demanding more days of your life, then the system is quietly cutting your wages, even while your paycheck says the opposite. Rule number 3, always ask yourself one simple question. What I am earning, is it money or is it preserved time? Because in the end, you do not live on the numbers inside a banking app. You live on the purchasing power of your life. And that is where the trick becomes personal. You may not care about Rome. You may not care about Isaac Newton, Roosevelt, or Nixon. But you should care that the same ounce of gold now demands far more days of labor from you than it demanded from an American worker in 1971. That is not an academic detail. That is your youth. Those are the mornings you have to wake up earlier. The overtime hours, the weekends that disappear, the years traded away for a measuring unit that is quietly rotting from the inside. The system does not need to slash your salary in public. It only needs to make the currency paying you weaker, slowly, steadily, and normally enough that you never get angry. That is why most people never realize they are being robbed. Nobody takes a wallet from their hands in the street. Nobody snatches cash out of their pocket. They are simply forced to work more to buy back the same standard of living. And once you see the world through that lens, gold stops looking like an investment. It becomes a clock measuring how honest the system still is. If 1 ounce of gold has preserved roughly the same purchasing power across 2,000 years, while modern currency keeps losing value over a few decades, then the problem is not gold. The problem is the measuring stick modern society forces you to use. So here is your homework. Take your annual income, divide it by the current price of 1 ounce of gold. Do not rationalize it. Do not soften the result. Just look at the number. That is a colder, truer, less dishonest measure of your labor. Not how many pieces of paper you earn, but how many ounces of something that has refused to lie. And once you have that number, ask yourself this. Has it been rising over the years? Or shrinking in silence? History has seen this before. The tools changed. The pattern didn't. In the next part of the story, we go one layer deeper. Because when people begin to realize money is no longer honest, the next thing to crack is not just purchasing power. It is trust in the banking system itself. Think carefully about what that means. 1 ounce of gold is not a ticket to wealth. It is a measuring stick for how honestly the system treats your time. When that same ounce of gold starts demanding more and more days of your labor, the message is not subtle. Your currency is weakening, and your working life is being sliced thinner, layer by layer. That is why people who only look at nominal wages always arrive late to the truth. They see bigger numbers. So they assume they are moving up. But what actually determines your standard of living is not the number of zeros in your account. It is the number of days of your life you must sacrifice for bread, rent, clothing, energy, and real assets. Paper money makes everything look like it is growing. Gold exposes what is actually shrinking. And once you see the world through that lens, many illusions begin to fall away. A raise is not always an increase in value. Saving is not always preserving purchasing power. And what people call safe is not always what protects your time. Gold is not the story. Your life is, and that is where the story becomes more dangerous. Because once enough people begin to sense that money is no longer honest, they do not stop at questioning their wages. They begin questioning where those wages are stored. The bank, that is the moment history always changes phase. First, people notice prices rising. Then they notice the currency weakening. Then they realize the problem is not only purchasing power. The problem is trust. And once trust begins to crack, the banking system does not collapse because of mathematics first. It collapses because of psychology first. A bank run does not begin with empty vaults. It begins with broken trust. Wages are the first layer of illusion. Bank deposits are the next one. And that is why this video does not end with gold. It uses gold to show you something more fundamental. The modern system does not just distort prices. It distorts people's sense of what safety even means. So let's close this entire video with one simple sentence. For 2,000 years, gold has held its role as a measuring stick for real labor. What keeps changing is not gold. What keeps changing is the system of power trying to redefine money, stretch the measuring stick, and force people to work more for the same standard of living. History has seen this before. The tools changed, the pattern didn't. So here is your homework. Take your annual income, divide it by the current price of 1 ounce of gold. Look directly at that number. That is a colder, truer, and far less dishonest measure of your labor than the nominal salary written on your paycheck. Then ask yourself one question. Over the last 5 years, has that number risen? Or has it been shrinking in silence? Leave your answer in the comments. I want to see, among the people watching this video, who is actually preserving the value of their time. And in the next video, we move to the next layer of illusion. Not wages, not gold, banks. More specifically, how a bank run really begins.